Welcome back to another episode of the Educated Homebuyer Live. This is where Josh and I answer your questions live here on the intranet, on the podcast about buying a house, refinancing a house, selling a house, rates, all of that good stuff. In addition, we usually start the episode by talking about the economy. But with that said, Josh, today we got inflation news. Inflation came in slightly higher than expectations. And with that, we saw bond yields, or we saw the 10-year treasury go up, and things weren't looking good there for a bit. But finally, we actually saw a little bit of a reprieve. Some believe it was due to rent shelter inflation data actually coming in a little bit better than some had expected. And in turn, we actually saw some retracement in those numbers. But what are your thoughts?
Well, on our fancy new Instagram channel for the podcast, we did a story yesterday predicting exactly what was going to happen. We knew that oil prices had gone up month over month, so that the headline number was going to be hot. The predictions, not Josh's predictions, the smart people that know how to reverse engineer this stuff, thought that the headline number was going to be up 0.3%. I think we're actually up 0.4. Is that what the hot read was, Jeb, or was the core? Either way.
Yeah. Core was 0.3 and headline was 0.6.
Okay.
Yeah.
So when the data hits, the first thing that happens is no one's been able to dig into the report and see where the inflation came from. And so they see the headline was a little bit hotter than expected. Market sells off and it's worse. And then fairly shortly, once people start digging through the data, seeing what they're seeing, the subcomponents, everyone was pretty comfortable with them. We talk about here on the show, Jeb, why the headline number is not the important number to look at for the Fed, because the Fed doesn't control it. They know that food and energy goes up and down for things that are outside of their control. So it's interesting. Oil prices relatively are not that high. 14 months ago, we were at like $110, $114 a barrel, and we're in the mid 80s right now. But about 6-8 weeks ago, it jumped about $10, $12 a barrel. If you're going and filling your car up, you've seen it. If you're in California, you've seen it to obscene levels, because our friends in Sacramento think it's fun paying $5 a gallon for gas. But overall, everything is moving in the right direction. If you look at 3-month average of core, we're at 2.5, 2.6, somewhere in that line. So still a little hotter than the 2% that everyone would like to see. And I believe we talked last week about the ISM services report. It really is core services that's remaining elevated. So almost everything falls under services: travel, restaurants, going to a play, going to a movie. Anything you do is feeding into that. So as long as consumers are spending, that may continue to remain elevated. Once that breaks and trends down, you're going to see overall inflation back at the 2% level. So unless you don't believe that's going to happen, or if you think oil is just going on the greatest run ever and is never coming back down, you have to think that inflation is somewhere near the peak or somewhere nearing where we want it to be. And within the next 3, 6, 9, 12 months should be back in a normal range.
No, and I think that's part of the concern is that, at the moment, not necessarily you and I, but in general, right, is that core inflation, some of the core services do stay high, and that you don't see that retracement in inflation as soon as we would like, which in turn means maybe the Fed keeps rates higher for longer, or they do another rate hike because they're not getting the number they want to see any quicker. Your thoughts on that? Well, I mean, it's unpredictable, right? We don't know, but we do know the economy is slowing, just based on some of the charts that we're going to look at tonight. So we do know things are slowing, but there seems to be this infinite amount of money out there in the market that people continue to spend. Every time I turn on, look at Instagram, look at somebody's going on a vacation. I'm like, that guy hasn't had a job in like 2 years. Like, what are they doing? So there's money going every direction. And with that, money gets spent in the economy. It keeps prices high and prices even moving higher to some regard. And that's why we're seeing, some of these numbers report like they do.
Yeah, the numbers today were tame enough and in line enough with what the Fed is wanting to see. You've seen a lot of the Fed speak over the last month has changed from saying, hey, we still have room to raise rates, we still likely have more work to do, to saying we've reached a point where we think we can sit back and sit and observe. So pretty reasonable. Like the most aggressive prognosticators are saying March of next year, we're going to see cuts. That's really 6 months out. I think that's pretty aggressive. So look at the flip side of that. They're saying they're not going to cut for the next 6 months. And for now, another hike is still on the table. So I think the last numbers we saw, Jeb, 50-50, that we get either one more hike in November or December. I think we're likely to see data that doesn't say, hey, inflation is back where the Fed wants it to be, but that it's trending in the right direction. We talked about at the very early part of these hikes, they're hiking. And people who look at the markets go, we still have negative real rates. We get inflation at 9% and you got Fed funds at 3%. It's a negative 6% on that. So we've gone the other way now. If we have inflation somewhere at 3.5%, we got a 5.25 Fed funds rate. We have a 2.25 real Fed funds rate. And as long as that is the case, they are restrictive. As inflation comes down, it gets more restrictive. So they do have the room to sit back and observe. I don't think any of us absolutely know what's going to happen next. You can look at a lot of the trends. The wild card is oil. And the unexplainable thing that no one has really been able to put their finger on is core services, because the consumer is still spending. But we've got the numbers there, Jeb, also showing there's just not enough money to keep spending the way they were. Core services is
well,
going
that
to moderate.
and you have student loans, starting back, right, as of September 1st. So in theory, all of those that have student loans that were spending money elsewhere, now that money doesn't get spent in the economy on productive things and or things that would drive up prices. It gets put back into student loans. Therefore, maybe less money floating around. Time will tell, right? It'll take a little bit of time for that to catch up. But with that said, let's take a look, as we always do, at inventory, right? Everything always comes back to supply and demand. And inventory is one of the things that we watch closely. So this week we saw an increase of like 400 homes week over week. Is this the, in theory, peak in inventory, and we're going to start to see declines from here? Hard to say. One thing to note, that this past week, when we're at the week these numbers are coming from, was the week from Labor Day. So you actually have one less day out there in the market with those numbers. So whether or not that had a huge impact or not, people not listing their homes, hard to say, but we didn't see a meaningful increase. So we more or less had flat week over week. Where we sit today, 509,156 homes. As always, these slides are in a link in the description, whether you're on the podcast, watching us on YouTube. So make sure you go and check that out if you want to see what we're looking at. Oh, Huntington Beach, 2305. So inventory is down a little bit from last week, kind of trending in that downward trajectory, if you will. Huntington Beach up week over week. In fact, this is the highest number we've seen in probably a month and a half. So inventory is a little bit higher in Huntington, not anywhere close to being a problem, but it's noticeable. So that Huntington inventory is up, but yet overall inventory in Orange County is down. Could it be because of price points? Could it be, that the homes that are staying on the market longer, building up those prices, are in the luxury space so people can't afford it? I haven't dove deep enough into those to tell you, but it's definitely something that we'll start watching. New listings. Look at that drop off. Holy cow, Josh. Logan Matashami, who is someone, again, we quote often, talk about often. He made a really good point in something I want to talk about. And that's the idea that if you see this Airbnb crash coming, if you see distressed sales coming to the market, this is essentially the chart that you'll see it in, right? Because you'll see a spike in new listings coming to the market. Well, what we're seeing is adversely what everybody's talking about, right? We're actually seeing new listings trend down in a deep way. So instead of a ton of new Airbnbs coming to the market, there's not, right? We have less new listings coming to the market. Therefore, inventory is essentially trending lower. But if and when that does happen, this is the chart that's going to show it, because we're going to see big jumps in inventory week over week. Inventory, a little bit of seasonality in this chart, and also kind of going back to 2015. Again, those dots in there are essentially the same week year over year. So as you can see, we're less inventory during the same period of time than we were last year, and probably pretty close to the peak when we're going to start to see inventory turn down. As I mentioned earlier, we went from 508,813 to 509,156. Again, an increase of about 300 and so homes. Last year, we saw inventory fall from 552 to 547. So we still have less property than we did last year. The peak for this year is where we currently sit. And the bottom for last year, we're sitting at 240,000 homes. So significantly less than where we are today. 14% fewer pending sales this year than last year. Again, affordability, less inventory, all of the things that we've talked about week over week. List prices, again, starting to trend down a little bit here. Median list price sitting at $444,990. And then median price of new listings sitting at $390 rather, and median home price sitting at $444,900. Median price of homes under contract still higher than we were last year, up 1%, sitting at $379,900. Price cuts kind of going along with the trend, more or less flat week over week. So 36% of those properties are having a price cut. And this is a chart, there's a couple charts in here I found interesting, received them in an email today, thought I would share, but share of households reporting it harder to obtain credit than 1 year ago. So looks like, again, sitting at 60-ish% of households that were surveyed. Surveys are one of those weird things, Josh, that kind of who did the survey. This one's actually the Federal Reserve. So a more notable source rather in this case, but people finding it more difficult. Why? Rates are, credit card debt is higher. People are running out of savings, all of the things that we've talked about. And this one is a chart I found interesting. Unemployment rate for California is sitting at 4.6%. United States unemployment is currently sitting at 3.8%. California tends to lead when it comes to unemployment. And so if that's the case, then chances are you're going to start to see unemployment go up as well. And you can kind of see the two have mirrored each other, going back, 1978, they've kind of pretty closely followed one another. So if, U.S. Unemployment tends to follow California, you're going to start to see some jumps in those numbers. And then again, we talked about inflation earlier. This is just a chart showing headline inflation, showing services, goods, and shelter, all trending in the right direction. Josh, it's going to lead us into this chart here. Again, talking about monthly change in the rent shelter numbers that we've been talking about.
Yeah, so we're almost back to sort of that high end of the range. If you look at the range from 2014 to pre-pandemic, there was a range there from 0.15 up to maybe 0.25, 0.35. And we're back at the high end of that range. And we can look at the numbers and see that it's going to moderate and you're going to be back where we were. So what is where we were? We had inflation that it was for the better part of 10 years. The Fed had a hard time spurring inflation to 2%. So when we look at that, we're also looking at core services. We talk about core services being inflated. So let's just look real quick at that chart you threw in there. Everything has come down nicely. Except for services. Shelter is trending down, and that one is easier to see into the future and know what it's going to look like. Mm-hmm. Goods way down. So the services piece, it's just elevated. And until we get it back down into that range of 2, maybe 2.5%, 3%, inflation is going to be higher than what the Fed wants it to be. So that's the big thing that we need to continue looking at, because I think shelter is going to take care of itself.
Yeah. And as we discussed earlier, shelter has essentially high readings all the way through March. So in theory, you're going to see shelter data month over month continue to decline, at least through the first part of next year. At which case, depending on what happens with rents and prices and that sort of, at that time, that could change those numbers. But for the foreseeable future, we should continue to trend down. This one is, what are we looking at here, Josh? Real gross domestic product versus gross domestic income.
GDP versus GDI. So gross domestic income is what people actually have as their income. It's not the output of the country, but money to spend. And if you look there through 22, GDI was higher than GDP. So we're seeing these reads that GDP is great. And trending up, but GDI has gone negative. So if people don't have money to spend, it is hard for GDP to go up. So it's something for us to look at, something that tells us that the next step is probably down for GDP. Looking at this is basically the same chart in a different way to see it. So you see GDI trended down right at about the same time we saw this inflection point up at GDP. Not realistic to see those diverge over time. This is basically the same information, but showing gray bars there. Gray bars are always bad. Those are always our recessions. Every time we get a divergence this big with GDI going down and GDP going up, you see a recession. It's been almost perfectly predictive from that end. You showed the chart, Jeb, of households reporting whether they're able to get credit. This is the 10-year Treasury yield less the real neutral Fed funds rate. So it's just showing tighter, more expensive credit when you can get it. Households reporting they're having a harder time getting it. This one here, your data, Jeb, that you were showing jobs there, inflation starting to trend up. So everyone keeps saying we're gonna have a soft landing. We've, the jobs market is really strong. Many of the Fed governors out there speaking over the last few months have been pointing to, you can't have a recession when the jobs market is this strong. Yet all it takes is a look back at the data is that jobs are the last thing to give up the ghost. And what we're seeing here is we've been trending down here. So this is what payroll does after you get that 3-month, 10-year yield curve inversion that everyone says has always been perfectly predictive of a recession coming forward. Well, what happens? You get that inversion and then they start trending down. So that's the gray bar there is the long-term average of, like, I think it goes back to like 1968, something here. And then the blue bar at the top is current. So we started at a much stronger jobs market. We've weakened down right in line with what we've seen and trending down there. So again, when we sit here and hope for better rates, we're looking for bad news for the economy. So it sounds like we're sitting here rooting for bad news. We're rooting for better rates, but the only thing that does that is a softer economy. Whether we root for it or not, whether we want it or not, whether we want lower, better interest rates, lower inflation, it's coming. This, Jeb, is just a chart here. The big thing there is you can see the trend of the 10-year Treasury. We are still in an uptrend. Every time we've hit the bottom, bounced all the way up. The good news is this time we didn't go all the way to the channel. We went to the middle, like greenish or bluish line there in the middle of the channel. At some point, we're going to need to break out of this and come down. So I've said and been on record here that I think we will see a slow grind lower in rates through the rest of the year. Well, this is telling us we're seeing a slow grind up, because if we go back there to say middle of the year, we went down, up, and haven't really gone a huge distance in terms of what the 10-year looks like after we had the big dip in the spring with the banking issues. So from this, it's a good chart to look at to let us know what's next. If we break through that blue line, we're going to go to an even higher level than what we've seen. I kind of think that we're going to have that 425, 434 kind of be a cap on the market. But until we break out of this blue line or green line at the bottom, we're not seeing a trend down in interest rates. We're definitely still in an upwards trend, even though over the last month it's been chopping sideways. You can see here we're up closer to the ceiling than the floor. We're closed at about 425 today. 434 has been the absolute ceiling. And what does that mean for you guys in terms of interest rates? 30-year fixed about 7.2%, FHA high sixes, VA about the same in terms of the high sixes. So not great from that end, but we haven't gotten worse, and it looks like the market is wanting to work in a better direction. But if we go back to the top of the show saying, hey, Fed's not likely to do anything till March, there's not a huge reason for the market to improve, but the market can improve off of data that they believe is leading the Fed to cut before the Fed actually cuts.
Okay, so I have a question, Josh. So the title of our video tonight is this basically a perfect storm brewing in the housing market? And a lot of what we report on tonight and week over week is slower economy, negativity almost to some extent, with regards to savings, with regards to output in the economy, growth in the economy, credit in the economy becoming more. So a lot of just really negative things overall. But yet we're still here on record saying that home prices probably aren't going to break to the downside in any meaningful way. See a flat, slightly up home price year over year is more or less the prediction. So, Josh, all of these things I say negative, yet we're over here saying not really negative with regards to home prices in a crash sort of mentality. You could see how people can be like, you guys are just cheerleaders for the housing market. Like there's no way that all of this over here doesn't affect this. So what are your thoughts on that?
It comes back to supply and demand, and we talk about a couple of different things. We've always talked, this market has taught us something new that I never thought of in terms of, we've always talked about demand, but willing and able demand. Always people willing to buy homes, but are they able to qualify, get a mortgage, and buy that house? I had never thought of willing and able supply. Anyone can put a for sale sign in their yard if they have equity, but are they willing to? So willing supply and willing demand and able demand. So I guess that's our balance right now. We have low able demand and low willing supply. As rates improve, those two things are likely to come into balance together or remain in balance. We'll get more demand as more people are able to qualify, are willing to take on lower monthly payments, whether that's a $200 lower a month, $500 lower a month, $700 lower a month. We will have more demand as rates improve. What our hope and expectation is that we will have additional supply as rates improve. Many homeowners who do not have to sell have just said, this is silly. Why would I sell and give up my $300,000 mortgage at 2.875 and take on a $500,000 mortgage at 7.25 in the current market? Well, we're hopeful that at 6%, 5.5%, 5%, more of those people will make that decision. So when you look at that, what is more likely to happen? The people that are outside of the market and unwilling or unable to buy right now, choosing not to buy when a small percentage of those people become more able to buy? Or are we more likely to get an excess amount of owners are still going to stay put, even if we have a 5.5% interest rate? Many won't because their family grew. They got a job opportunity. There's reasons why they would be willing to give up the ultra low interest rate, but most won't. So we have actual limited supply because we've underbuilt. Then we have limited supply due to interest rate lock-in, whether certain experts want to believe it or not. So demand is going to remain relatively strong. That's my take on it. And I will go back and say, I don't think this is a perfect storm in terms of weakness or strength where prices are going to go up. We just don't have enough able demand to push prices significantly higher.
Yeah, and what I'll add to that, I mean, I think that was, I mean, more or less, we're in on the same page with that is that anybody putting their home on the market is also a buyer, right? So that seller is a buyer. So it's a 1-for-1 exchange. You put one on the market, you take one off. So net there's zero inventory added to the market. And something you said to start comes back to supply and demand. You need more supply on the market than you have the number of buyers willing to buy said goods, in this case, real estate. So inventory is not able to grow if somebody's selling and taking one off, right? And now it allows an opportunity for some people that are sitting on the sidelines to buy a home. And we know there are people sitting on the sidelines waiting to do that. So when we come here and we say, yeah, all of these things are happening and they all look kind of grim, a little negative, not really great for the overall economy. The idea there is that all of those things lead to less growth in the economy, which leads to less inflation, which leads to the Fed, whether or not they wait to break something, but ultimately seeing a slower economy, seeing that they've done what they've been trying to do, taking their foot off the brake, and at some point offering some easing, whether it's a pause, actually reducing rates, or at some point getting to, way less restrictive policy by reducing the Fed funds rate and or starting to buy mortgage-backed securities again. Whatever it is, they start easing, and with that ease, spreads are compressed, allowing rates again to trend lower. And rates trending lower in an environment where inventory is already a problem creates other problems, right? And not in a negative way. Well, I guess it could be in a negative way if you don't own a home, because it further escalates what we've seen over the last couple of years. So hopefully that kind of breaks it down. Again, not cheerleaders for housing. I don't think Josh or I want to see home prices continue to do what they're doing. It's not healthy. It's not good when you eliminate first-time home buyers essentially from the market. That's not a positive thing. But
that's 60% of my client base, Jeb. So if you're sitting here saying, it makes me laugh when I get people saying realtors and mortgage people love these high prices. Nothing could be further than the truth. What I love is a high volume of willing and able buyers, and we do not have that. So I don't want wish for a 20, 25, 30% correction in prices to increase affordability. I would be perfectly happy if we had 3 to 5 years of very level prices, and during that time we went from 7% to 4.5% rates, and incomes increased 20%, because that would mean more and more of the people that are calling me on a day-to-day basis can qualify and are willing to make the payment. Like right now, it's rough. It is rough.
I would rather sell 30 homes that are $1 million than sell 15 homes that are $1.5 million. Right? I mean, like I'd rather have the volume for a number of reasons. It just, everything. The volume is better. So I would like to do more transactions. Lower prices lead to more transactions. But nevertheless, we are going to dive into your questions. But before we do that, I am going to do a little plug here. Alex says that he listens to the podcast while he's at work. So if you guys didn't know, there is an actual podcast aside from the live show here. It has its own channel, The Educated Homebuyer, here on YouTube. 2,000 plus of you guys are subs. Those of you who are not, I would like to ask a favor that you go over there, subscribe to the channel, listen to the content. If you're more of an audio person, you can get us on Spotify, on Apple, on all of the different platforms out there. And if you like the content, rate us, review us. It helps the algorithm. I'll tell you, that thing is growing exponentially, and a lot of it is because of you guys. So this last week we talked about the long game of real estate, the idea of buying now and waiting, what that actually means. But it's a deep dive. It's different than this show because we talk about something specifically. It's outlined. It is broken down in a way to really dive into one topic versus kind of jumping all over the place, which is what we do here. So go check that out. And if you haven't done so already on this channel, liking, subscribing, that stuff helps as well. Shows support and helps us continue to do what we're doing. And then the last thing I'll add is Instagram, TikTok. We now have an Educated Homebuyer channel. So if you want to get in touch with us there, you can send direct messages, a little bit easier to communicate versus sending emails back and forth and that sort of thing. So go give us a follow. And for that, we're going to dive into some questions, Josh. So we've got a couple coming in here. Here's a really good one because we're actually going to talk about home equity loans next week on the podcast. But are lenders still lending for home equity loans at the moment?
Yes. And if you look post 2008, the big banks got crushed on HELOCs. So they are much, much more conservative. So someone had made a comment. I think it was Kim made a comment. Hey, banks and credit unions are offering good terms. Yes, they are much more conservative in terms of their underwriting, how much you can borrow, what debt to income you can go, how they're going to calculate your income. So it can be harder to qualify. And if you do, it's going to be a 30 to 45 day process. Lender like myself on the other side, terms are good. Maybe not as good, not quite as good as what you're going to get from a bank or a credit union, but much more flexible underwriting, including like bank statement loans for self-employed people. Almost anything can be done for the right borrower. So it's sort of that balance of what you're looking at and what you're needing. We also had a comment in here, Jeb. Someone said, no, I would never recommend a HELOC. Stay away from adjustable rates. You should get it fixed. If you remember in early 22, when rates first started going up and they went all the way into the high 3s and the low 4s, and so no one wanted to do a cash out refinance, people started going, hey, I'm getting a HELOC and it's 3%. I can still get that super low interest rate. What I told anyone at that time is, please, God, do not take out that adjustable rate mortgage because it's going to go up for the foreseeable future. And I had no expectation that they were going to go this high, but that is exactly what's happened. Everyone that has those HELOCs has ridden them all the way up. Well, we are somewhere near the peak in these interest rates. So my advice would be the opposite. Then I was saying, please take a fixed second, even if you don't have an immediate need for the money, so you can lock in a 5% rate on that money. No one did it. They all took HELOCs. And right now they're saying, I want a fixed second because I don't want an adjustable rate. Well, the benefit of that adjustable rate when you're at or near a peak is you can write it down going forward. So it's not an easy decision. We have 3, 4, 5 borrowers doing HELOCs right now, all slightly unique situations. And that decision is different for everyone. You have to walk through it. It's just like everything else. The numbers never lie. Pencil it out and see which decision is better for you. There's not a hard and fast rule.
Absolutely. Question from Willing here. Good question. Say, should a buyer who is selling their home, their primary residence, get pre-qualified before their current home goes under contract? Borrower doesn't want credit pulled yet because it may take a few months to sell. How would you advise? Absolutely get pre-approved. Get your credit run. Make sure you're in a position to buy a home. Like, what happens if you sell your home, go under contract, and then you find out that your credit's garbage for something? Something happened you didn't know about. Now you have a problem with your credit. You no longer qualify to buy a home, and your home's under contract. You're in a pickle, if you will. So do the work now and know and have the safety net of having done it. It'll be a much better situation. And if you have your credit pulled twice, right, in over a period of time, it's not going to do anything to your credit. I mean, it might drop it a point or two. It's just all the rapid pulling and doing crazy things, getting multiple credit cards at once, getting all of these different things happening all at one time. That's what creates inquiries and creates issues with credit. A credit pull here and there is not a big deal.
The credit report's good for 120 days. I would like to think that you will get an offer and close on your house. I mean, you use an example, Jeb, the seller that is selling and buying in Long Beach. What was the time frame from when you talked to them, getting them under contract?
Well, that one was quick, so that's not a good example. But let's say right now I have one under contract. It's going to close in 10 days or so, 9 days, 9/22. That one took 140 days to sell. I mean, so in that case, that buyer, I'm giving you the other side of what you're trying to prove here. It can take that long. So either way, they should be smart enough to do that, right? Because again, it puts them
at a minimum, Jeb, do the full pre-approval with a soft credit pull. If for some reason you are so freaked out about that, the soft pulls are much, much better than they used to be. We can at least look and see what's reporting. The credit score is not going to be perfect, but it gives us a very, very good idea. So we can make sure income-wise, you're good. Asset-wise, you're good. Credit record, debts, debt to income ratio, all of that is good. We can even in most cases run an automated approval for a conventional loan using the soft pull if we pull it through the right system. So if for some reason you are completely freaked out and unwilling to pull a credit report today, which is silly, we still have a workaround that can get you 95% of the peace of mind that you need.
Good stuff. Tibet says, I'm looking to lock in my rate this week at 7.15. Lender and friends and families say I can always refinance later. My current closing costs will be around $33,000 on a $720,000 loan. So part of that's probably not closing costs. Part of it's probably the actual prepaids and things that need to be paid, but we're not talking about that here. So where I'm going with this is that in theory, you can refinance. I think anyone giving anyone the certainty that you can do X right now, or that you're going to have the opportunity to do X, it's true, but it's not always giving the full story, right? So for the better part of last year, people were like, marry the property, date the rate, right? With the idea that, hey, find the right property. Don't worry about the rate because there's going to be an opportunity to refinance it in a short period of time. Well, here we are, an extended period of time later, and rates are still high. And I'll be the first to tell you, I thought rates would stay lower, but I shit on that comment from the very first time it came out. You can go back and watch videos where I said I didn't like that because it's setting the wrong precedent. And with that, we've seen people have to keep rates probably longer than they thought they would, and probably will longer than they have to. So just be comfortable with the payment now. And if you get the opportunity to go lower, it's a benefit. Like, hey, that was awesome. I'm glad I was able to take advantage of that, because you could have the case where the property, there's not the equity in the property because something changed. So just know there are factors that can keep you from doing it, but the likelihood is high that you're going to be able to take advantage of it. It's just when. So
Let's look at the rest of it, Jeb. $720,000 loan. Even if they're putting 20% down, that's a $900,000 purchase. $33,000. Let's say there's $10,000 for prepaids. There should not be $23,000 of closing costs on
Maybe
a
they're buying down the rate.
7.15% rate. They're getting 7.15. They ain't buying it down much. And if you say, hey, credit score is not that great. Okay, cool. Why are we not possibly considering FHA? There's just a lot of questions here. So this could be the absolute perfect best structure for you. What I would say is if this is the only lender you've spoken to, you owe it yourself to make one phone call and talk to one additional lender. I would prefer that it be a broker, someone that has access to multiple sources versus just one rate sheet that they can talk to you every day. I don't have a problem if we look at it and go, you're in the best structure. I don't want to steal that loan officer's loan. This is a tough market for everyone. We're not there to steal loans. We're out there to make sure people get the best transaction that they are qualified for. That sounds excessive from the little information that we have here. Make one phone call to a broker, double check those numbers, and just make sure there's not money to be saved.
Good stuff. If you need a referral to a lender, there's a link scrolling at the bottom there. Refer you to somebody I know, like, and trust that can guide you through that process. It could be Josh. It could be David. It could be a couple other people. There's really only a handful that we're referring out to. So you're in really, really good hands. So that said, Josh, really another question here related to the mortgage side of things. Cash withdrawals, deposits from your bank. Is there a limit before you have to provide a paper trail? So if I transfer $1 because I got $1 in Venmo and I want that thing in my bank account and I transfer it over, do I have to paper trail that?
So jumbo lenders will set their own guidelines. 90% of the transactions we're talking about in here are FHA or Fannie Freddie. So FHA is 1% of the purchase price. So you're buying a $500,000 house, deposit more than $5,000, you're going to have to paper trail it and say where it came from. Some lenders will be more restrictive than that. You can point them to the guideline and say, please don't bother me on this. No guarantee. Lenders can set their own overlays. On Fannie Freddie, it's 50% of monthly qualifying income. So same situation, say your family, your household, you and your co-borrower, $10,000 total gross monthly qualifying income. We can have up to $5,000 deposit in that situation. So it's going to vary by your purchase price or by your income, depending on the loan type that you are getting.
Good. Question here from Elay says, Josh, if the Fed pauses and lowers rates, won't that have the effect of lowering short-term yields while the 10-year stays in the same range? Bad news for mortgage rates going down significantly? ? So asking a question there. What are your thoughts?
So long-term rates more closely follow inflation expectations. So long-term rates not coming down are telling you that the market does not believe convincingly that inflation is coming down to where we think it's going to be in 6 to 12 months. So the Fed cuts, we've said this before, the Fed does not hike mortgage rates. They control short-term rates. So you're 100% correct. When it comes time for the Fed to cut, what they're going to do is they will be impacting short-term interest rates, and you'll see the yield curve uninvert. And that is sort of a sign that we're moving in the right direction. And hopefully long-term rates will be coming down because we will have seen inflation come down, which is why the Fed is cutting. It's not following because the Fed is cutting. The Fed is looking at the same thing that long-term bond investors are looking at, that inflation is under control, the economy is slowing. We don't have to keep rates as high as they are right now.
Good stuff. Torio, question we haven't gotten before. Please explain homeowners tax exemption and homestead exemption in California. Thank you for you both. So do we have an exemption here in California, homestead exemption?
It's tiny. It's tiny.
Yeah.
You want me to Google it?
Sure. In California, you basically have Prop 13, which oh, my hamstring's tightening up. Holy cow, dude! I just turned my leg the wrong way. The same one as last time.
Old.
Oh my goodness, guys! I almost went down to the floor again. Last week, I was in Josh's office, flexed my leg up, and literally fell to the ground because my hamstring got so tight. Not good, guys. I was laying on the floor earlier stretching because my back is tight. So 43, that's what 43 looks like. Anyway, you have Prop 13 here in California, which essentially keeps your taxes from going up, more than 2% per year. So, the homestead that some states have, California doesn't really need it because of Prop 13, but what do we have?
So $7,000, Jeb. So with 1 to 1.25 tax rate. And for most people in California, it's $70, $80 break on your tax bill. Very, very minimal. So the second piece of that homestead exemption protects a chunk of equity from
being
debtors. So
Yep.
yeah. Yep.
So if you're sued or something else, there's some sort of homestead there that keeps it. If you want more detail, we can talk about it in more detail, but I think that kind of sums it up. Let's see. Louis says, is FHA recommended for first-time buyers, even if you're able to put 20% down? So I would say typically the answer would be no. The conventional should, in theory, end up being a better loan unless you have really, really poor credit or something else going on there. Josh, what are your thoughts on that?
At 20% down, you have the mortgage insurance go away entirely. So never going to happen with an FHA. So FHA, you can put 20% down, and the only benefit you're getting is the mortgage insurance goes from 0.55 per month to 0.50, and it will automatically fall off after 11 years because you put 10% or more down. If we're talking less, 10, 15% down, I would say you absolutely still want to consider and look at FHA. If you can do 20% and you're comfortable with it, we're not using every last nickel of your funds, so you still have some nice reserves, it probably leans towards doing it conventional. What I will say is the numbers never lie. Have your lender do a comparison, and a comparison of apples to apples FHA to conventional. So 3.5% down to 5%, or a 5% FHA to 5% conventional, just so you can see the relative differences. Then compare that to your 20% down conventional, where the mortgage insurance goes away entirely. The other reason why I'm inclined to lean with Jeb here in just this hypothetical situation is FHA requires an upfront mortgage insurance premium. So even if you put 20% down, they're going to add 1.75% back on top of that. So you end up with like a 91.5% or 81.5% loan to value. So FHA loans are awesome. They've gotten much better relative to conventional loans as we've had increased conventional LLPAs and reduced FHA mortgage insurance. But in this situation, probably leans towards conventional.
All right. I got two different questions here regarding VA, Josh. I know you do a VA live every Tuesday. So this could be helpful if you're a veteran out there and you want to know more about that. Josh can talk about it here in just a second about that. They only talk about VA loans, but a really easy one to start with, Josh. Are veterans required to pay property taxes?
So the $24 million question is, where are you located? And what is do you are required to pay property taxes? Different states have varying degrees of to be 100% disabled. So per the VA, you have a 100% disability rating, but it's going to vary by what state you're in. Do you have a disability rating, and what is it? In general, veterans are still going to pay property taxes unless they have a disability rating.
There you go. Alex, I have a veteran loan, VA loan. I'm in California. My loan team has advised me to hold off because of interest rates and high prices. Should I be looking for another opinion? So I'm taking this or reading this as they already have a VA loan, considering refinancing potentially, and being told that it's not worth it at this time.
My answer to that would be that my job as a lender is to never tell you when to buy. It's to advise you with what it looks like when you buy, what I've seen in 27 years of doing this, and answering your questions. I shouldn't be telling you you should buy, and I shouldn't be telling you you should not buy. You've come to me saying, what do I qualify for? And you probably do want to ask my opinion based off of long-term in the business. But I would absolutely talk to another lender, realize that there is in any sales business a potential that you get to someone that, rather than looking out for your best interest, is saying, I need to eat next month, so I think you should absolutely buy a house. So in this case, it's generally a good sign that they're not trying to push you into buying. But at the same time, the VA loan, you can always do an IRRRL. So let's say if you thought today was a good time to buy, you're comfortable with the payment, you no longer want to rent, and you understand the risks of increases, decreases in property values. With a VA loan, you do not have to have an appraisal. So if and when rates go down, you will always be able to benefit from that, assuming you have made your mortgage I would probably talk to one other lender, but it is your decision. And I don't mean that to say ignore those people. They may be right. They're seeing your finances and your situation. It may be the absolute right and perfect advice, but you're the one that has to make that decision based off of the insights and guidance your lender and realtor are giving you.
All right, good stuff. That we're gonna hide. Gonna go to a couple of other questions here.
We got some comments here, Jeb, that we were freezing and breaking up.
Yeah, I saw you freezing. I didn't see me freezing, but they said I froze, so I'm not sure. So anyway, we're doing the best we can with crappy internet. So
yes,
we have fiber optic internet, and yet we can't stream.
What is it? It's gigabit internet, fiber optic gigabit internet, but we can't stream.
And we can't stream 1080p to YouTube. Imagine that. Sorry, we're doing the best we can. So this question came. He's asked it twice. Typically, somebody asks a question twice, I say ignore them. Just so you know, Bill. But we're going to answer the question, even though it has nothing to do with housing at the moment. What are your thoughts or opinions on Rhino Shield ceramic paint, Josh, as opposed to the standard exterior paint? Is it worth the best part?
Well, Jeb, you froze on me right in the middle of the question, but I think I got
fantastic.
the gist. I got the gist of what you were saying. I know absolutely nothing about paint. I would defer to my auto detailer, and he always wants me to do a $2,000, $3,000, $4,000 ceramic coating on it. So I know that it's good for him, and I do generally trust him. I just don't know whether I'm willing to part with the cash.
I have it on my car. It came like they did it when I bought it. I don't know. Is it worth it? I think it what helps with the chipping and other things. I don't know. Is it? I have no idea because I don't know what the car would have been like without it. So I'll tell you, it looks really nice when it's clean, but that's about the extent of it.
Well, one of the things they say with the ceramic coating is it doesn't pick up dirt as easily, as easier to keep clean. Do you notice that?
I do not notice that. Well, especially Josh, when you work in a construction zone, literally, I got my car washed today, and I can assure you, when I walk out there, there's a layer of dust on it because of the amount of construction going on. So
all day, every day,
everybody's like, get a white car. It'll look clean. It does for about 2 hours, and then it picks up everything else. So, well, we got off topic, so let's get back on. All right, Josh.
We got another VA question. Let's just make it a whole VA show tonight. At first, Jeb, I thought this was the Mike D, but it's not. It's Mike McD. Different guy.
Mike D.
So
Beastie Boys, Mike D.
Jeb, in one of your videos, you mentioned how first-time VA loan users will pay an upfront VA funding fee. I've read that can be waived based off of disability ratings. So yes, anyone with a 10% or greater disability rating will not pay a funding fee. And the funding fee is not limited to first-time buyers. First-time buyer gets a reduced funding fee. If you come back and do zero down VA, sell that house 10 years later, buy another home with zero down VA financing, you will pay a much larger VA funding fee. So anyone with a 10% or greater disability rating will be exempt from the funding fee. So at that point, you are truly having no mortgage insurance. VA doesn't have monthly mortgage insurance. They use the funding fee in lieu of that. And if you have a disability rating, you're not paying that either.
All right, good stuff. Chizzy Black
hasn't been here in a while. Jeb.
Or just has not asked questions. Maybe they've been here, just not asked questions.
Good point.
Why would the Fed cut rates this year? Wouldn't it end up increasing demand and in turn increase home prices, which will contribute to inflation? So, Josh, what are your thoughts on that?
Can't argue with the logic, and I don't think they're going to cut. We talked about at the top of the show that they have reached a point where I believe they've done the heavy lifting and done the work, and they seem to believe it as well. And they're saying, let's just sit back and see how it plays out. Again, I would think that the aggressive prognosticators who are saying March of next year for the first cuts, I think the economy is deteriorating faster than I expect it to if they're cutting already in March.
Agreed. Not likely to happen this year, but the theory behind what you're saying is accurate. Here's one for you, Josh. If you really want to piss a lot of people off, let's answer this one. Do you think if Trump gets elected, he will get the Fed to drop rates? So let's talk not necessarily about Trump getting elected, but does he have any control over the Fed and what they do with rates?
Today's Trump Day. Today we recorded and explained how he destroyed and eliminated the tax benefits of homeownership. So tune in next Tuesday when we explain that in detail. It does not matter who gets elected. The Fed is going to be cutting regardless of who is in the White House. If it's Trump, he will be taking credit for it. I can tell you that, whether he gets them to or not. It's just the way he does things, jawbones what he wants, and then takes credit for it when it happens or doesn't happen or whatnot.
So what power does the presidency have over the Fed?
None.
Right. So whether the Fed does what they want to do or does not, the president basically has no say. There's no veto. There's no power for them to take in order to change anything. So, that said, they are looking at two different things, right? They're looking at employment and they're essentially looking at inflation. And so based on what happens there, dual mandate will decide how they, in theory, proceed with regards to rates. All right. Do you think he's going to get elected, Josh? I mean, I'll ask the question. It was asked.
Here's the thing. I think that we as Americans deserve a president not named Biden or Trump. I don't look and I don't see any other spectacular options. I think we deserve something new and better and different.
There you go. Josh Lewis for president. That
just
would be
imagine
awful.
the stuff
that would be so bad.
The videos and clips.
Oh, I can only imagine.
I would get canceled within a weekend.
I would move. I would definitely move out of the country. Let's see here.
I'm going to come up on the short end of this, but this one's for you. Eli wants to know who would win a pickup basketball game between the 5 all-time best players from Kinston and the 5 all-time best players from Linwood.
That one's easy. I think Kinston's got it.
I'm
not sure there is a best player from.
Oh no,
I think Josh might be the best player from his hometown.
No, we have a lot of really good basketball players from Linwood, but Kinston, I believe, still takes the honor of most NBA players from one single tiny podunk town.
I believe you're right. But yeah, and actually, there's one being drafted. Well, no, not drafted. Just went into going into college this year. I forget what school. 2 guys actually, Damian Dunn and somebody else maybe headed in. Anyway, that'll probably be in the NBA at some point as well. But nevertheless, I digress. So let's dive into Josh. The idea of shopping lenders. I do want to talk about. It's 5:51. Man, time flies. So 54 likes at the moment. Been on here 50 minutes. Like to, do what I normally do 20 minutes into the show and ask a favor. If you found any value tonight, if you like the content, do us a favor, hit that thumbs up. If you haven't checked out the Educated Homebuyer channel, the podcast, go do that. Follow us on Instagram, all of that good stuff. Again, it helps the algorithm. Next week, we're going to give an ultimatum. If we don't hit a certain number of likes, we're just going to stop talking. Like we're just going to be here silent, stare at the camera the whole time. But anyway, going back to locking rates, Josh, yes.
No, let's go back to the more important question, Kinston versus Linwood. This is amazing in that there is a website that I found in like 2 seconds that I know the number from Kinston already wins, but in Linwood, California, we've had 2 NBA players, Rick Adelman and David Greenwood. Would you get 5 or 6 out of Kinston?
Oh, you've had 8 or 9.
Yeah. See, no contest. We empirically answered it, not just with Jeb's opinion.
Yeah. Anyway, why do some lenders offer locking rates while shopping and others don't? So, Josh, what is the idea behind that?
So here is the fun and interesting news. There is no such thing as a rate lock. Lenders offer them, meaning, yes, they offer them to you, but there's nowhere that a lender can go and lock a rate. They can hedge against changes in interest rates going forward. There's a cost to that. What the cost increases based off of delivery rates. So if you lock 100 loans and deliver 100 loans, the hedging is cheaper than locking 100 loans and delivering 10 of them. That's why they want information from you. They want it tied to your social. They want it tied to a property address. They don't have to have it that way. So it's just the cost is greater to them. So typically, though not always, the lender could eat this additional cost. But what you'll see is the lenders that offer them generally don't have the best rates. They have high margins. So they go, we can offer this feature and tell people it's a great thing, and they will come to us and they won't quite notice that we don't have the best rates and terms. So that's not a hard and fast rule. They can obviously choose to eat that in their margins. Most don't.
No, that's good. I mean, again, something I say often, not often enough, is that if your lender has a national televised commercial on Super Bowl Sunday, chances are you're paying for that in some way, right? I mean, they can't deliver these things without somebody paying for it, right? So, which means there has to be a profit in order to do that. Now, again, some of these lenders, because of bulk and different things, can offer great rates to the perfect home buyer out there that is flawless in every way. That's not the majority of people. Some people have some nuances in credit and and differences in down payment and different things. And a lot of times these people eat that higher cost. So if you're getting a loan, just have a conversation with more than one person and get a quote. The lowest rate isn't always the best rate. Just have a good feeling about it. Go with your gut. Your gut, that sort of thing matters. So that's my two cents.
We covered this on the VA Live show last night, how to compare among lenders. And someone said, well, I would talk to 5 or 7 lenders. I go, if you want to confuse yourself, talk to 5 to 7 lenders. You should not need to talk to more than 3, unless you're super analytical and you want to break out a spreadsheet and you're going to go just hell bent on finding the world's lowest interest rate. If you talk to 2 minimum, so you have a point of comparison, so you know that the 1 isn't just telling you an absurdly high rate. 3 gives you sort of a frame of reference of how do you relate to each one of them, how do their terms match up with one another, but the number is definitely more than 1.
All right, good stuff. This one is a question that is difficult to answer somehow. Something happened here on my screen. There we go. Robert, would a 29-year-old composition roof be a valid ask for a seller credit due to the end of life? Yes, it's a valid ask, but also understand in 20 years of doing real estate, what I see more often than not in situations like this, just in general, if there's not leaks in the roof, the seller's response is going to be, it's not leaking. It's fine. It's been fine for me, whatever, right? So that is the response in most cases from a seller who has something that's in functioning condition, even though it's old, right? Could be a water heater, could be a furnace, could be name it, right? I mean, I have one right now we're trying to negotiate where there's a couple of things that my client, there's ducting in the attic, for example, that has duct tape on a couple of areas in the ducting. My client would like the ducting replaced. The seller goes, no, the airflow is great. Why would I replace something that's working? Right? So you just have to be prepared with that and be willing to try to negotiate, right? You might not get the full credit. You might get a portion of it. So it's just one of those things that give and take. I mean, in theory, it's reasonable that you're asking for it, but you also have to understand what's your market look like with inventory. Is it primarily still a seller's market? Are they getting what they wanted? Were there multiple offers? What was the situation when you bought the home? Because all of those things go into that factor, or factor in when that seller is making a response. If you were the only offer in 150 days, probably more willing to work with you. If there were 30 offers in 2 days, you might find somebody that says, screw it, I want the house, I'm willing to deal with it. So just know what you're working with. All right, Josh, I asked for likes a minute ago, Josh. You know how many I got?
How many?
Four likes. Four likes. We only have 1 like for basically the minutes that we've been on here. We got 58 likes. We've been on for 58 minutes. We're doing a really
We're going to have to go on strike.
Crappy job. We clearly offer no value here because I'm seeing it in the numbers. The numbers say we both suck. So, Josh, what are we going to do with our Wednesday nights when we can this? Do you have any plans?
Wing Wednesday. Unfortunately,
Wednesday.
our wing place went out of business.
Yes, we need a new wing place.
You got to go to Joe's. Wing Nuts is gone. If you are a restaurateur, Joe's is good. If you're a restaurateur in Orange County, we need an awesome wing place.
And not just Orange County, like Central Orange, like Huntington Beach would be really nice. But don't tell me it's in San Clemente or it's in Fullerton, because I'm not going out there to eat.
Yorba Linda.
Yeah. Give it to me local and I'll go. Costa Mesa, right where Wingnuts was. Just open it back up.
Right. Open it right back up. Same menu, same
And I'll be
everything.
there. And see,
better management.
notice how we transitioned the conversation away from housing because nobody was finding value in it. See, that's what's going to happen
We can
next
talk
week, guys.
about food and
Next
basketball
week,
every
we're going to
week if
show
you'd
up.
like.
We're going to talk about ceramic paint and just different things. Because hey, that's where we're at.
Jeb, we do have a couple of good and easy mortgage questions here.
All right, let's hear it.
Benzo, what about USDA loans? Are they great? Two things to be aware of. Property has to be eligible in a rural area. So there's a map for looking that up. Income limits. So if you are underneath the income limits and buying in an eligible area, very similar to an FHA loan, similar in rate, lower monthly mortgage insurance, lower upfront mortgage insurance. So a very good loan program, but it's very specific in terms of geo targeting. You have to be in what's designated as a rural area. So if you and the property are eligible, it can be a great loan program. Jay Homeboy back with a good question. Some people are 500 to 100,000 ahead of their mortgage schedule by making
50
larger
to
monthly
100,
payments.
not 500.
Oh, 50 to 100,000 by making bigger monthly payments. Do they still need to add more money down when they go to recast? No, because you've already made the large principal reduction. You just have to request the recast. It is important to remember lenders do not have to go along with the recast. Most times they will, but they don't have to give it to you. So it's just a matter of calling the servicer and finding out what their process is and seeing if they will go along with it. They most likely will, but not guaranteed.
All right, Josh. Last one. Well, not necessarily the last one, but it might be the last one because still a lack
It's a good one. I like this one. You didn't get enough likes to ask any more answer.
No, there's a lack of people like willing to give us support here. Raul says, can't talk. How would you comp a property that is unique in lot size and square foot, but no recent sold active pending that is close enough to get an estimate price? So you would go outside of that area. So this is difficult because I only do real estate in Southern California where, in the market that I serve, there's nothing like that. I often wonder a similar thing in areas like where I grew up, where there's a big house, a lot of land, and then there's nothing even remotely close to that property anywhere. What do? You got to go as far out as you can go to find something that is reasonable. And then you have to make adjustments for lot size, for property size, for varying factors in there that help you come up with the value. I mean, this is honestly something I'm really pulling that out of, of my hat, so to speak, when I'm answering that question, because this is something that I'm not super familiar with, but I would think that that's how they would approach it. Josh, what are your thoughts?
Same thing. I almost look at this as myself as an investor. When you find a unique property, what are you looking at? You're going to expand the geo. So go to a wider radius.
Yep.
You're going to expand the time, go further back in time. Yep. You want to find something similar. If there is literally nothing and it's a one of a kind property and there's nothing within 25 miles in the last 3 years, that's hard for me. There are parts of the country that are rural. Any state in the country has rural areas where there might be one home within 100 miles and they have to do this stuff. For me, it's so far out of my comfort zone that I want to see something similar that has sold, or just know that I'm getting such a spectacular price that I'm cool with it either way.
Right. Here's a good question, Josh. And I think this is a really good one to end on. Just in general, right? And you can change the numbers, how they work for your situation. But there are people in this situation. So I've been renting for 8 years from the same landlord. Rent has gone up $300 in that 8-year period of time. Should I do another year, essentially staying at the same rate, or a 6-month lease? Would ideally like to buy. So you got somebody that's not raising the rent on you. Rent's more or less staying the same. So you're not having that creep, if you will, with rent inflation. Do you still buy? Do you wait? Is there less of a reason to go out and buy because of that? What are your thoughts?
Well, here, let's go back and look at the 4 factors. So Talk about tax benefits. That's not really something that's come into play. We talk about fixing your payment. It's not a big worry here, but it has gone up 3% over the 8 years. Talk about forced savings that you have with a mortgage. When you make that mortgage payment, a portion of it is going towards principal every month. And probably the big one in this one is leverage. Buy a $300,000 property, goes up 3% in a year. That's $9,000. It's going to go up $50,000, $60,000 over a 5-year period at 3% inflation. So you're missing out on those things. What are you getting? Probably have a lower cost than owning. So as long as you're able to save and invest, that forced savings, you can replicate that. Is the leverage going to be that big of a deal? Like, I don't know. I don't look and I see a recipe for 5, 6, 7% appreciation. Although we've got Zillow, CoreLogic, all these places saying they're seeing 5 to 10% appreciation. So it could happen. I don't necessarily see it. It just comes down to, if you're comfortable and you like the low payment and it allows you to aggressively save, I don't think there's a big incentive to move right now. The flip side, go back, watch the shows we did in 2020 and 2021. I said, if you want to buy, get your butt out there because the appreciation is there. Interest rates are really low.
Yeah,
You're going to get all of that thing.
Yep.
Yeah. So we don't have that right now. So I don't think you have that urgency. So you're asking the question, should I? I'm kind of comfortable here. Should I? Leads me more to believe stay put, unless you're just not disciplined enough to save, stay there and rent. Because a lot of people, like, it's like anything else, it's that hedonic treadmill. You get a raise and then magically you don't save anymore because you're just going out to eat more. You bought some nice jeans. The cool thing about housing is you don't have that option. Once you bite that off, you're going to make that payment. You're going to have that forced savings. All of those things are kind of the equivalent. I've used this example before of when you get a new job and they auto enroll you in your 401k, because if it's 3 or 5% of your paycheck, you don't miss it. But it is important over 5, 7, 10 years to see what that grows to. Housing is very similar. It's passive in that you have to put a roof over your head and you want to get those things working for you. But today, there's not a huge sense of urgency.
With that, guys, that's where we're going to end it. So appreciate you guys being here. We're here every Wednesday at 5 o'clock to answer your questions, update you on the economy, update you on what's going on. For that, I'd like to ask a favor. If you hit that thumbs up, like the video, if you haven't subscribed to the channel, that helps out. Go check out the podcast, The Educated Homebuyer, here on YouTube as well. Lastly, if you want to get in touch with Josh or a lender anywhere in the country, there's a link scrolling the bottom. It'll also get you in touch with me and or a real estate agent if you want to do that. And then again, Instagram, TikTok, Educated Homebuyer, Jeb Smith on there as well. Would love to connect with you guys. I always love seeing who I'm talking to, right? So a lot of you guys have no idea what you look like, where you are, any of that stuff. It's a good way to connect and get to know who I'm talking to. So always love you guys connecting and reaching out. So Instagram, check us out. Until next week, guys, adios.